Hello class, my name is Miss Higgins. Today we are going to introduce the topic of money and banking and take a brief look at the different sections we will cover over the coming lessons. We are going to briefly explain the history of money and the functions of money, outline the different types of money and financial institutions, describe how banks create credit and why this needs to be controlled, review the importance of the European Central Bank and Central Bank of Ireland, and summarise Ireland's banking collapse. Before we start our introduction to this topic, you may be asking yourself, why do we need to study this topic? Why is it so important? Why do I need to know how banks create credit and why it needs to be controlled? The answer is simple and one you've all heard before. Money makes the world go round. Do you recall the definition of economics from the beginning of the year? Economics is the study of how individuals use scarce resources to satisfy their needs and their wants. Money is a scarce resource. Once we have satisfied our needs, we look to satisfy our wants. Money helps us to satisfy both our needs and our wants, and obtaining that money is something we will all try to achieve. We can do so with the help of the banking system. Finally, in the Leaving Cert exam, this topic will always come up, and most notably in section B, where you can gain 20 to 75 marks, so it's not something that should be overlooked. Let's start with a brief history of money and how money was formed. But firstly, do you know what money is? We all know it to be the shiny coins collected in the big Coca-Cola bottle or the crispy note we love to see in our birthday cards. But what is its purpose? Money is used as a means of exchange. Before coins and notes were created, a system of barter was in place where people exchanged one product for the other. For example, people exchanged potatoes for meat. But this wasn't always possible as people became uncertain of the exchange rate, and you needed to find someone who wanted what you had to exchange and had what you needed, called double coincidence of needs and wants. To overcome this, precious metals such as gold and silver were created to replace the barter system and create a more meaningful medium of exchange, measure of value and store of wealth. During the 18th century, people started to become worried about the safety of their valuable commodity and deposited their gold with goldsmiths, who in turn created a business of lending this deposited gold to others in exchange for a fee. This was the beginning of the banking system as we know it today and the introduction of credit creation. Throughout the centuries, the business of banking has evolved into a multi-billion enterprise. Money has since changed from precious metals to paper currency, to checks, to electronic payments, to internet banking. From physically having to exchange one good for the other has now evolved into clicking a few buttons and automatically transferring wealth. There are many different types of financial institutions: commercial banks, merchant banks, credit unions and post offices. All financial services companies have twin objectives: profitability and liquidity. Their aim is to make the best profit for their shareholders and at the same time hold enough cash to meet the demand of its customers. To become profitable, banks can create credit to meet the needs and wants of its customers. Banks presume that all those customers that have placed cash on deposit will not all recall their money at the same time. Therefore, they can use a certain percentage of their deposits to lend money to other customers and charge a fee for this service called an interest rate. In creating credit, banks are increasing the money supply of an economy. The money supply of an economy includes currency in circulation and current account balances known as M1, deposit account balances known as M2, and all other loan instruments up to 2 years known as M3. But surely this money supply needs to be controlled. A prime example of why this and the creation of credit needs to be controlled is the Irish banking collapse in 2008. But we'll speak more about this later on. Firstly, let's discuss how the money supply can be controlled. The main aim of the European Central Bank, or the ECB, is to maintain price stability within the Eurozone. This is done by monitoring inflation and adjusting interest rates, so as to influence consumer spending and in turn the circulation of money in an economy. The ECB has full control over Ireland's monetary policy. It monitors and influences our rate of interest, money supply, credit availability and the protection of the value of the euro. the Central Bank of Ireland works with the ECB in maintaining price stability in Ireland by implementing ECB decisions on monetary policies. Let's now revert back to the need for credit control and regulation in the banking system. In 2008 there was a world credit crunch. This meant that banks would no longer lend money to each other on the interbank market, a market only banks had access to for funding. As the supply of money fell, the interest rate for borrowing money rose. In 2007, Irish primary banks had borrowed just under €400 billion. This left Irish banks in predicament. They now owed billions of money on the interbank market, but did not have the funds to meet their obligations as credit availability had dried up. This led to the Irish Bank Guarantee in 2008. Who do you think will pay for this government capitalisation? Well, your family and friends have been. You already are, through limited government expenditure on public services due to huge government debt, and your future family will be. So, do you still think that monetary policy and control and regulation of the banking system has no effect to your lives? Where can you see this topic fitting in with the rest of your school subjects? Possibly history? Geography? Business studies? Remember, economics is a social science. Let's take a quick look back at our learning intentions for today. So, we have briefly explained the history of money and the functions of money, outlined the different types of money and financial institutions, we've described how banks create credit and why this needs to be controlled, we reviewed the importance of the European Central Bank and Central Bank of Ireland, and we've summarised Ireland's banking collapse. Thank you for viewing this presentation. Now, let's get started on our in-depth analysis of money and banking.
Created using Powtoon.